Hello everyone, welcome back to Property Ponderings. My name's Craig Nicol from Nicol Buyer Advisory in Melbourne, Australia, where we help people buy and renovate their properties. I'm bringing to you over 15 years of property experience that I'm hoping to pass on to help you make better property buying decisions and build the future that you're chasing. Today we are talking about how you can build wealth through property with just 2 investment properties. And we'll explore a couple of case studies to show you how it's possible. Now, the 2 investment property strategy is a stark difference to the 30 or 40 or 50 properties that people are spruiking through social media. So I thought the slow and the steady 2 investment property strategy, and some say boring and conservative, is a simple way to go about building wealth, and a way that is in the reach of everyday Australians, I believe, and is a wonderful way to build a solid nest egg for later on in life. So here we go, let's break it down. So let's take a look at the scenario where we purchased 2 properties, each priced at $750,000. This is a realistic figure for properties in the middle ring suburbs of Melbourne, where we can expect both capital growth and solid rental demand. Firstly, choosing the right properties matters. So in this example, we buy 1 property in Werribee, a growing suburb west of Melbourne, where $750,000 can secure a good-sized 3-bedroom home. Werribee could be a great choice for property investors due to the ongoing infrastructure developments, including the $1.8 billion Werribee East Employment Precinct, which is attracting more residents and driving property demand. For your second investment, you choose Frankston, a bayside suburb about 40 kilometres southeast of the Melbourne CBD. Frankston has seen significant growth due to its affordability, lifestyle appeal, and proximity to the Mornington Peninsula. At $750,000, you could buy a 3 to 4 bedroom home in a family-friendly area that appeals to renters and offers long-term capital growth potential. Now, both Werribee and Frankston are just being used as examples here. This isn't investment advice to go out and buy in these areas, but I'm just trying to use them to give you a bit more of a clearer illustration of how this 2 property strategy could work into the future. Now, the second part of the strategy that's important is leverage and smart debt management. So for both properties, you take out loans of 80%, meaning you're borrowing $600,000 per property and contributing $150,000 for each as a deposit, plus the stamp duty costs, which will be around that $35,000 mark. So with 2 properties, you're leveraging $300,000, which if we add stamp duty in, it's actually closer to $370,000 of your own money to control $1.5 million worth of assets. Now let's say each property appreciates by a modest 6% annually, which is achievable in growth areas. In the first year alone, this results in an increase of $45,000 in value for each property, or $90,000 in total. And that's just the first year. Over 5 years, your properties could increase by around $255,000 each, totaling $510,000 across both properties, using that 6% growth annually. Because you're leveraging, you're reaping the full benefits of the appreciation on the entire property value, not just your initial deposit, which is one of the benefits of property over shares. Now, the third point to think about here is maximizing rental income and cash flow in this sort of portfolio. So let's talk about rental returns. In Werribee, properties typically offer rental yields around that 4% mark. For your $750,000 investment, this translates to an annual rental income of roughly $30,000. Frankston offers similar rental yields, so you can expect another $30,000 per year in rent from that property. That's a combined rental income of $60,000 per year, which goes a long way in covering your loan repayments. So let's assume your annual interest cost on each $600,000 loan at a 5% interest is around $30,000 per property. Your rental income nearly covers these interest payments, leaving you with a small shortfall, but this gap can often be managed with negative gearing, allowing you to offset the losses against your taxable income in the early days. Now, I know I've used a 5% interest rate, but as just for a simple calculation, over the last 10 years, it certainly would be a fairly accurate average, if not a little bit high. But currently, yeah, it's a little bit low. So that's fine. It's not the point of the story here. We're not dealing with exact numbers. All I'm trying to do is just explain a case study of how things will work out with just a 2 investment property strategy. Because at the end of the day, as you'll see later, a few $1,000s here or there with incorrect figures isn't really going to matter in the longer run. All right, so in addition as well, let's remember depreciation on both the building and fixtures can further reduce your tax liability and improve your overall cash flow position. The fourth part of this case study to consider is just the power of time. Patience is a key when building wealth through property, so let's assume you hold on to these 2 properties for 10 years, allowing time for them to grow. If they continue appreciating at 6% annually, both properties will be worth approximately $1.34 million each after a decade. At this point, your combined portfolio would be valued at $2.68 million, up from the original $1.5 million. Your equity position is now very strong. Initially, you invested $370,000 approximately for both properties, but after 10 years, you've gained an additional $1.58 million in equity, minus the remaining loan balances. So the fifth point here to consider is once you've built up significant equity, there are a few options for continuing your wealth building journey if you want. So you could sell one property, let's say, and you decide to sell the Werribee property that was worth $1.34 million. After paying off the $600,000 loan, you're left with approximately $740,000 in cash. If you had a principal and interest loan, then the amount of cash that you get out would be much more significant than that. But let's just say before selling costs and the potential capital gains tax that you do pull out that $740,000. You could use this money to pay off the remaining loan on the Frankston property, leaving you with an unencumbered asset that generates passive rental income. So that sell one property out of the 2 is a popular strategy down the track. Some people do it with, say, 3 or 4 properties, and they will sell 1 or 2 of those to pay off the other 2. But that sell down strategy can be really effective. Refinancing is another option. So alternatively, you could just refinance both properties to pull out some of the equity, using it as a deposit on a 3rd investment property. Now, this way you're expanding your portfolio while continuing to hold the original 2 properties, allowing them to keep growing in value over time. You could also use that money that you pull out for other things as well, for lifestyle, and also investing in businesses or shares or other options as well. Now, the 6th thing to think about is the long-term exit strategy. Now, wealth creation with just 2 properties doesn't necessarily mean you'll need to sell both to fund your lifestyle or retirement. Many investors opt to hold one property debt-free, providing a steady rental income stream, while selling the other to access the cash for further investments or to fund more of a comfortable lifestyle in retirement. Another approach is just to hold both properties while refinancing periodically to access equity, which allows you to continue investing in additional properties or other asset classes without needing to sell. The other thing you can do is when you've paid off the debt, you can just simply live off the rental income from the 2 properties. So let's recap on this case study. So what does this look like in numbers? You initially invested $370,000 across 2 properties valued at $750,000 each in Werribee and Frankston. Over 10 years, with capital growth of 6% annually, your properties grow to a combined value of $2.68 million and your equity increases by around $1.58 million. By selling one property, you could potentially own the second one outright, providing you with ongoing rental income. Alternatively, you can simply just keep holding, and over that next 10 years or 20 years, you'll see significant equity growth and a much more neutrally to positively cash flowed situation. Or alternatively, you can leverage your equity to further grow your investment property. So you can see with even just 2 investment properties, you can build significant wealth, especially if you invest strategically in high growth areas. And in this example, we've only used a 6% growth. There are many areas with much more significant growth, and doesn't also include if you renovate and add value and get a significant equity uplift from doing something like that as well. So with leverage, smart debt management and holding for the long term, you can see significant capital growth and you can build a solid financial foundation. In just 10 years, you could be sitting on more than $1 million in equity, giving you flexibility for future investments or a comfortable retirement. Getting to 2 properties is the easy part, but holding them for the long term is often the difficult part. Alright, so that ends another episode of Property Ponderings. I hope that has just given you a few small tips or ideas to make some better buying decisions on your next property purchase. You don't have to leverage yourself to the hilltops. You can use a more safe and conservative way to build wealth. If you do want to discuss anything further from this podcast, or if you're wanting to get some tailored buying or renovating advice, please feel free to reach out to me at 0400 122 081. Or you can email me at craig@nickelbaradvisory.com.au. Thanks guys, we'll chat again soon. The information provided in this podcast is for general information purposes only and does not constitute financial, legal or professional advice. While we aim to provide accurate and up-to-date information, every property transaction and investment is unique. You should seek the advice of a qualified professional before making any financial decisions. The opinions expressed in this podcast are our own and are not a substitute for tailored advice from a financial advisor or a real estate professional. We encourage you to consult with a qualified expert who can address your specific needs and circumstances.